Right now, the United States is approaching $40 trillion in debt. Gold has reached record highs. Central banks continue accumulating physical gold, and investors are asking a question that could reshape the next decade. What happens if capital begins moving away from bonds? Because for more than 40 years, bonds have been one of the foundations of the financial system. But if investors begin looking elsewhere, where does that money go? Gold, silver, energy, infrastructure. And what does that mean for your savings, your retirement, and your purchasing power? Tonight, we're going to follow that money. And we're going to start with where it may be going before we explain why. Let's follow the money. When investors become concerned about debt, inflation, and long-term purchasing power, capital rarely disappears, it moves. Historically, some of that money moves towards real assets that can't simply be created by policy decisions. Gold, for an example, not because it pays interest and not because it produces cash flow, but because some investors view it as a store of value when confidence in paper assets begin to shift. Silver, unlike gold, silver is at the intersection of money and industry. Its demands come from investments, electronics, solar, industrial application, energy infrastructure, pipelines, power generations, industrial assets. Because modern economics run on energy, and energy remains one of the fundamental inputs of economic growth. In recent years, some investors have focused on strategic infrastructures. That's data centers, AI, intelligence, electric grids, and critical minerals. The systems required to support the next generation of technology. And notice something important. These are not all the same asset class, but they share common characteristics. They are tied to real-world production, real-world demand, or real-world scarcity. Now, that doesn't mean investors abandon bonds. The bond market remains essential to the financial system. But when the system shifts, even small reallocations become significant, because we're not talking about millions of dollars. We're talking about trillions. A small percentage move from a massive market can create a very large capital flow. So the next question becomes, what are some investors beginning to look? And why are they looking elsewhere? And to answer that, we need to understand what changed. For decades, investors benefited from a powerful trend. Interest rates generally moved lower. And as interest rates fell, bond prices rose. Borrowing became cheaper. Mortgages became more affordable. Corporations expanded. Governments borrowed more easily, and financial markets adapted to that environment. On this chart, you can see the long-term decline in interest rates that shaped much of the last 40 years. Many investors became accustomed to a world where interest rates eventually moved lower, but today the environment looks different. Inflation has returned. Inflation rates are higher than they were for much of the previous decade, and debt levels continue climbing. This doesn't mean bonds are finished. It simply means investors are reassessing assumptions, because the next 40 years may not look like the last 40 years. Most people hear the debt number, nearly $40 trillion. But more important issue is the trajectory. On this chart, you can see debt climbing, continuing to rise year after year. Every year, the government spends more than it collects. And those deficits add to the debt. And the larger the debt becomes, the more interest must be paid. Think of it like a credit card balance. A small balance may be manageable. A larger balance creates a larger payment. So now apply that principle to the largest economy in the world. As debt rises, interest expense rises. As interest expense rises, more borrowing may be required. And that creates pressure on the system, not necessarily tomorrow, not necessarily next year, but eventually, because debt can grow for a long time. Yet it cannot outgrow the economy forever. At some point, the system adjusts. So how does the system adjust? And there are three broad possibilities. Scenario one, economic growth accelerates. The economy grows faster than debt, productivity improves, innovation expands output, and debt becomes easier to manage. And this is the most constructive outcome. Scenario two, inflation remains elevated. So debt becomes easier to repay in dollars that buy less. As incomes and tax revenues rise with inflation, the burden of existing debt becomes easier to manage in real terms. But households experience the opposite effect. Their purchasing power declines, groceries cost more, services cost more, and savings buy less over time. Scenario three is for financial repression, a term most people never heard of. But this occurs when interest rates remain below inflation for extended periods. Savers lose purchasing power, borrowers benefit, and debt becomes easier to manage over time. On this graph, you can see how each path reduces debt pressure through a different mechanism. Now, history shows versions of all three occurred before. The question isn't which one is guaranteed. The question is which one markets begin pricing. And this brings us to another important question. Who finances the system? Treasury securities are purchased by investors around the world, banks, insurance companies, pension funds, foreign government, asset managers, and individual investors. On this chart, you can see the major groups that participate in the treasury market. But there is one more buyer that matters: the Federal Reserve. When markets come under pressure, under stress, or when policymakers want to support liquidity, the Fed can step in and buy treasury securities. That does not mean there are no buyers. It means the treasury markets is so important that policymakers may support it when financial conditions tighten. For decades, treasuries have been viewed as one of the safest assets available, and they remain a cornerstone of global finance. But investors care about more than safety. They care about return. And when inflation rises and debt levels increases, investors may demand higher yield. Higher yield means higher borrowing costs, and that creates another layer of pressure. On this CBO chart, CBO projects net interest payments rising from 3.3% of GDP in 2026 to 4.6% by 2036. This is where debt, interest rates, and investor behaviors intersect. If investors demand higher yield, interest expenses rise. If interest expenses rise, deficit becomes greater, and larger deficits require additional borrowing. And additional borrowing increases debt. And a larger debt can cause investors to demand higher yield. So economists call this a feedback loop. One force reinforcing another. On this diagram, you can see how each step feeds into the next. This doesn't mean crisis, it doesn't mean a collapse, but it does mean markets begin paying close attention, because eventually investors must decide how much risk they're willing to accept and how they want to position capital. If you want to understand where systems may be heading, there are three signals worth watching. First, the 10-year Treasury yield. It tells you what investors are demanding to lend money. Second, the federal deficit. It tells you how much additional borrowing is required. In this CBO chart, you can see projected deficits and rising interest costs. Third, gold. Because gold often reflects how investors view long-term purchasing power. On these charts, you can see three signals side by side. None of these signals predict the future, but together, they tell a story about confidence, risk, and capital flows. And those are often the signals that matter most. But there's another development worth watching, and that's stable coins, because stable coins are backed by Treasury securities. And if stable coins continue to grow, they could become another source of demand for government debt. And that does not mean debt disappear, but it may change how the system finances itself. And that is why stable coins may become one of the most important pieces of the next monetary system. Because the biggest shifts in wealth rarely happen overnight. They happen when systems adjust. Debt systems, monetary systems, and capital allocation systems. The investor who understands those shifts often see the change before it reaches the headline. If this episode gave you clarity, like the video, subscribe if you're serious about understanding macro trends, and share this with someone who's trying to understand where the money is moving next. In the next episode, we're examining stablecoins and why some believe they could become the next settlement layer for the global financial system. Until next time, keep watching the signals and keep following the money.